Okay, so now let's move on to talk about why we invested in MSCI. Um, Also, we're near on the end of time. I will probably go over time talking about this. And if you're new, a lot of these concepts are definitely like not going to be familiar, especially if you're new to investing. And such as fundamentals, different ratios and stuff. But that's okay. Um, you can switch it up. You're welcome to stay here, or you can leave right now if you think this won't be too much of a help, or you can just stay here. Um, a lot of the ratios and stuff you can search up like later then. I think there's a recording so you can like look at this later. Um, or can you ask me later after this meeting? But yeah, let's talk about MSCI. MSCI are one of the Hoperation Fund's new positions. Um, Provides critical decision support tools and solutions for the investment community to manage investment processes worldwide. Yeah. First of all, I'm going to talk about the business model of this company, if you don't know. Because before you buy a stock, the most important thing, besides its fundamentals, is to understand how it makes money. So MSCI um, makes money by providing investment decision support tools, um, risk management solutions, analytics and stuff, and many like mutual fund managers, investment companies. Many of these finance people are customers of MSCI. MSCI is also a major beneficiary, which means it has gotten a lot of profits from the shift from actively managed investments to passive investments. Basically, from actively managed mutual funds to ETFs or index funds. MSCI has three main segments it makes money from: the index segment, the analytics segment, and the ESG and climate segment. The index segment makes up 56% of revenues, the analytics segment makes up 24% of its revenues, and the ESG and climate, where it gives like ratings for businesses, like um of like how well you're like concerned with environmental protection, that makes up 11% of revenues. MSCI's clients come from asset managers, hedge funds, um, assets owners, mutual fund owners, insurance companies, wealth managers, corporate advisors, investment companies, etc. MSCI has also a superb, an amazing 95% customer retention rate, and most of its revenue is subscription based, meaning making its earnings very predictable. Usually, the stock market tends to give higher valuations to companies with high growth predictability, as they're usually more stable. MSCI Inc. has earned its wide moat through its successful index franchise, monetized through subscriptions, asset-themed fees, and transaction royalties. Management expects the company's revenue and generally to keep growing at low double-digit rates over the long term, with operating profit margins staying in the high 50s. So it's estimated here to have revenue growth rate of in the teens, 20s, etc. About the teens, 20s. MSCI also has a few risks though. MSCI has concentrated customers. For example, BlackRock, the largest asset manager in US, represents almost 50% of MSCI's asset-based fees, which limits MSCI's price power. Generally, if most or a lot or a big portion of a company's revenue comes from one company or a few companies, that makes it slightly riskier because if the company or companies leave, then most of its profits will be affected. This also limits MSCI's pricing power. They can't as easily bargain with BlackRock. However, a good thing is that MSCI sales are diversified, with 45% coming from the US, 38% from Europe, the Middle East and Africa, and 17% from Asia Pacific. When these non-US regions experience bull markets, MSCI sales have the potential to grow significantly. Here you can see a pie chart of MSCI subscription run rate by the area world. Okay, so does anyone have any questions so far for this? Okay then. So let's move on to talk about the management. The CEO of MSCI, Henry Fernandez, has served since 1998. So he's worked in this company as CEO for more than 2 decades. That makes him very experienced. He knows this company very well. He has a stake of almost $1 billion in MSCI, or 2.7% of the company. All of the insiders total in the company own 3.2% of MSCI. MSCI also has a very sustainable competitive advantage. It's a leader in the index market with pricing power, and it has a very strong moat. Due to a networking effect, it's very hard for its customers to switch to another company just because, this new company has slightly lower costs. Um, this is due, let's just say you're this tiny little company starting out and you give like ratings, financial advice, tools, investment tools, and analytics. No one's really going to believe you. Like, they're not easily going to switch to you and be your customer because you you don't have that trustworthiness. They're not going to believe you. Like, even though I know your prices might be slightly lower, they would rather stick with MSCI because MSCI has been here for a long time. It's very trustworthy. They know its tools are good. And also, even if just one customer switches to you, um, due to networking effect, it's going to be hard for like the other customers to switch to you. Therefore, the customers in MSCI are very loyal. They have a 97% revenue retention. To prove my point, in the past 10 years, the gross margin, which is a good sign of a company's competitive advantages and moat, is greater than 70%, and the ROTC or ROIC keeps on increasing. So it's like MSCI is also in an attractive end market and rides on macro trends. It benefits from the macro trend of passive investing, especially investing in ex-US markets and ESG. Again, MSCI has a pretty good, healthy balance sheet too. It has an interest coverage of 7.7. Generally, the higher the interest coverage, the more likely it is to pay back its debt. Its net debt over free cash flow is 3.5. That's pretty high, but again, it keeps on decreasing. So generally, the lower the net debt over free cash flow, the better. And you can see from this graph, then the net debt over free cash flow keeps on decreasing. Right. The goodwill over assets is 53.3%. This is high, but it is still pretty tolerable. The debt over equity ratio, since MSCI has like a considerable amount of debt, its equity ratio is its equity is actually negative. However, it has bought back a lot of its stocks to become treasury stocks. So if we add that as equity, the debt over equity ratio is 0.7. But again, this company has a very high moat. That's why it takes on more debt because it knows it will pay it back probably. Its current ratio 0.96. Again, for companies with very strong moats, they tend to take on more debt because they know they will have like pretty stable earnings and they will be able to at some point pay back that debt. Its quick ratio is 0.84. The capital operation, for capital operation, the CAPEX, basically the amount of capital it invests in getting more like equipment or like getting more assets, maintaining those assets over sales is 0.8%. Its CAPEX over operating cash flow is 2%. So clearly MSCI has super low capital intensity. Like it doesn't spend a lot of money in like getting like new tools or anything because it doesn't really need them. So it's for capital allocations, ROIC is 24.5%, still pretty high. Generally, as a rule, I like it around or above 30%. ROE is 19.8%. Its profitability, its gross margin is super high, that's really good. 82.1%. Its operating margin is 53.7%. Its net profit margin, 43.8%. Free cash flow margin, 45.7%, and free cash flow over net income, 110%. Okay, does anyone have any questions for me so far? Or you want me to repeat a slide? Okay. Oh yeah, it's okay if like you're new to investing and you don't really understand a lot of the things I am talking about. That's perfectly okay. Um, but over time, hope like everybody can like learn more about investing and choosing stocks. Um, yeah, the important thing is to like participate in discussions, learn more, read more books, and listen to more lectures and stuff. And yeah. For the stock-based compensation of MSCI, it's 7.4%. So generally, the less stock-based compensation, the better. Stock-based compensation is where like the company gives its employees stocks of the company in exchange for like when the company gives its employees shares of the company, kind of like besides paying the money, they also pay them with stocks. So, however, when you're paying your employees those stocks, the stocks of the company can get pretty watered down. So, um, for the for the growth, the revenue growth in the past 3 years is 13.5%. The EPS growth in the past 3 years is 21.3%. The expected revenue growth in the next 2 years is 10.5%, and the expected EPS growth in the next 2 years is 11.4%. The PEG is also 3.96. For dividends and yields, the dividend yield is 1.1%. So it's at least a pretty good dividend yield. Its dividend YOY growth is greater than 20%. You can see like its dividend amounts are steadily growing. Its payout ratio is 42.8%. Its shareholder yield is 2.4%. Its earnings yield is 2.7%, free cash flow yield 3.0%, and buyback. Yeah, it does buy back some of its stocks, so yeah, that's pretty good. Because when a company buys back its stocks, or shares of its stocks, that means like there's less shares in circulation, which so each share is worth more. For valuation ratios, PE is 37.5, PS is 16.4, the PE over free cash flow ratio is 33.6, the EV over free cash flow 36.8, and the EV over EBITDA is 33.2. So is the P ratio is pretty high actually for the stock. It's 37.5. But I believe that it's a really good company. So while the P ratio is pretty high, it's kind of slightly overvalued. However, it is a good company though. So, in my opinion, it's a fair price. Okay, so, okay, does anyone want me to repeat something? Okay. Um, so now let's move on to the valuation of MSCI. The, so here's just like bit of Python code for calculating the valuation according to the 10-year discounted cash flow method. If you don't know what a discounted cash flow method is, you can find it in a video on my YouTube channel. Over here, I can copy and paste the link if you want. Okay, sure. Stop here. Hold on. Oh yeah, speaking of which, for oh Heidi, you asked what the PG ratio is, right? Hold on. The PG is like basically like the PE, except it takes into account like the growth rate of the earnings. So it's like more like I guess it can sometimes be like more of an accurate measure of like the P ratio because it takes in like the growth rate. Hold on, everyone. Oh yeah, here's the link to my YouTube channel. You can talk more. You can watch it later. Um, you can watch it later. It's like about um a valuation method called the discounted cash flow or DCF method. So this time I used a 10-year DCF method. Generally, for general companies or stocks, I would use a 5-year discounted cash flow method. However, their earnings for MSCI is pretty stable, so this time I used the 10-year discounted cash flow method. So from this, you can see the stock's intrinsic value is 529.39 per share. Um, Again, though, validating stocks, using and like using this method, this is more of an art than like a scientific method. There's no exactly like um way you can. There's not an exact way you can um like you can like do it, and like even like small changes in like the even small changes in like numbers can affect the value or the valuation you calculate by large amounts. So this is just like a general like overview, like not general overview, like a general estimate of the stock's intrinsic value. So here I calculated 529.39. Anything around that though is okay. So you can see from this from this screenshot, I bought MSCI at $559.85. However, again, this is around the intrinsic value I calculated using the discounted cash flow method. So again, anything around that is okay, and I believe I bought the stock at a pretty fair price. Okay. So here, this graph I plotted the P ratio, um, and the EV over a bit. So, here you can see like the P ratios changes over time, as well as the EV over a bit ratio over time. So, you can see from this graph that the P ratio as of now, from 2020 to 2022, 23-ish, is comparatively lower than the than this time period. However, through the long term, especially before 2020, the P ratio is average slightly higher on the higher side. So through this graph, though I only put it here so you guys can like see it and make your own like and determine your own opinion, or your own like or decide on your own if the stock is slightly overvalued or undervalued. Um, this graph is just for you to like decide your own opinion. So yeah, that's it for my review on MSCI, the reasons I bought it, etc. But does anyone like have any questions or want me to like repeat a slide?